Yeah, hello again. Here is again our channel with lectures on tax and related issues in German and international law. This is again the lecture General Introduction to Tax Law, and today our topic is Chapter 6, an outline of limited tax liability with examples from German tax law. Here's a short overview about what we are going to do. And before we lose time on that, we just begin at the beginning. So, a short repetition. What was limited tax liability in contrast to unlimited tax liability? Um, it exists with income tax and corporation tax, and both has in common that in contrast to unlimited tax liability, where the worldwide income is taxed, in cases of limited tax liability, the tax claim is restricted, so is limited to the inland income. So in case of German limited tax liability, the tax claim is limited to income which has been earned in Germany or which comes from Germany. By the way, the term limited tax liability is not internationally generally used. Other countries use terms like the taxation of non-residents or non-resident taxation. That is nothing else than the same in different words. You know, or you are already used to that due to the fact that English is so widespread as a language in so many countries that you can never be sure that the official terms for something are everywhere the same, because many different countries, many different laws, many official terms. That is self-evident, and we must live with that. I choose limited tax liability as translation because that comes nearest to the German expression, and it also has the advantage that if we speak of limited tax liability, you directly get reminded that we here speak about German tax law and not about English or US law. Okay, let's start after this has been said to what were the cases where limited tax liability applies. In case of income tax, you knew unlimited taxpayers were those who have a residence or their habitual abode in Germany. So limited tax liability is left over for the cases where unlimited tax liability does not exist. So here we end up with the cases where there is neither residence nor habitual abode in the German territory. In case of corporation tax, we had unlimited tax liability given in cases where there was either the statutory seat, so the official postal address, which is nothing else than the registered office in English terms, or the place of management, where neither of those is in the inland. There we have limited tax liability. So good. Now, the general rule can be defined as limited tax liability always is to be tested only in cases where unlimited tax liability cannot be found. So it's clear that when you test a case, first you test all possibilities that there could be unlimited tax liability. Only when everything does not apply there, then you move over to limited tax liability. Officially, limited tax liability is not given if somebody has, let's go back, neither residence nor habitual abode and no German income, for example. But that makes no sense for practical approaches. Officially, naturally, it is just a diplomatic approach to say if somebody has to pay no taxes in Germany, we don't call that person a limited taxpayer. And naturally, we don't expect from a person who has no income at all to be taxed to regard himself or herself as a taxpayer and, for example, hand in a tax return sheet with a €0 declaration in Germany. So one avoids to call these people limited taxpayers if they have no income at all, which could be covered by the tax. But for practical approaches, when you test a case, naturally it's clear when somebody is not subject to unlimited tax liability, then the rules according to which you have to test that person's case are the limited tax liability rules, and clear consequences. If you really test according to these rules, then all the events which are combined with that person, then naturally, if nothing is left over, we don't call that person a limited tax liability taxpayer anymore. That for testing the case, limited tax liability rules naturally must be applied. So I recommend to you, if you want to be on the very safe side, if you make statements on personal tax liability, first would be the case no unlimited tax liability is given. So the case has to be tested according to the rules of limited tax liability. See Section 1.4 ESDG or see Section 2.1 KSDG. Then you are on the safe side, because then you have not stated that you have a limited taxpayer. You just say, which is absolutely true, that the case has to be tested according to the rules of limited tax liability, and this is definitively true if there is no unlimited tax liability given. Okay, so always test unlimited tax liability first and then move on to the limited one. There is, by the way, one strange exception. Since 1996, I believe, there is for certain cases an option where somebody who is subject to limited tax liability may, in the end of the year, opt to be treated as an unlimited tax liability taxpayer if all that person's worldwide income is already claimed by the German state as taxable under the usual limited tax liability rules, or if outside Germany there is nearly nothing left over which is taxed by other states than Germany. Nearly all the worldwide income that is regarded as fulfilled if somebody earns, if Germany claims under limited tax liability rules more than 90% of the worldwide income of that person, or that nearly nothing is left untaxed by Germany from the worldwide income, that is regarded as fulfilled if left untaxed by Germany is an amount which is lower than the amount which is needed for survival. Yeah, but that can be neglected here, because that is something which you can only find out and test at the end of a case, because then you must already know how much of the worldwide income, so of all events which happen during a year with a certain taxpayer, if more than 90% or nearly nothing of the worldwide income is left untaxed under the normal rules of limited tax liability. So first you would always test the cases of these persons according to limited tax liability, and then at the very end of a case you can test the possibility of the taxpayer can use that option, and then can state what, test, check, whatever is changed by that option. Good. Now let's talk about characteristics of limited tax liability. The first idea is it covers only income from the inland. So in case of German tax liability, only income from Germany. Now, naturally, it's not always evident where income has been earned. So it must be defined in the tax laws which income is so closely related to the inland, that it can be seen as inland income. Probably you can expect that the usual catalog or the normal catalog of income, in our case in Germany, 7 types of income, is repeated, and then that it's specified for any type of income, under which circumstances it can be regarded as coming from the inland. Then another aspect which can often be found is that limited tax liability sometimes does not cover every income which has been earned in the inland, but that the one or other kind of income is, although it has a clear connection to the inland, is left out. We will have to think about the economic background of such a decision of the legislator. Naturally, that is something which you must know. States are, in theory, sovereign states, so they can design their laws as they wish to design them. And so they can design freely or decide freely which things they tax and which things they leave untaxed. Naturally, if they have some common sense, there will be reasons why they tax certain items from the inland, and there will be reasons why they leave out other income. So for us, it might be interesting to think about the reasons for the one or the other decision. And what else is strange with limited tax liability, or where there is a difference to the average unlimited tax liability taxpayer? That's the way how taxation is done. Sometimes that is different. Somebody who lives in the country, an unlimited tax liability taxpayer, usually has to hand in a tax declaration once after the end of the year, has to make a list, an overview of all his income from all the 7 types of income. Everything, the plus and the minuses, have to be added up. Then special expenses, so special personal allowances and extraordinary expenses are deducted, and some other items are deducted. And after some many steps of calculation, a total taxable income is the result, and that is subjected to the tax tariff, and an income tax liability is the result. Then you see what our taxpayer has to pay for that year. Now that is highly complicated and requires that you are familiar, at least a bit, with the law of that country. If you are not, you need a tax advisor or somebody else, and that costs money. Sometimes you can't expect that from foreigners. So there must be ways found how the taxation of foreigners can be simplified. And the legislator must decide where such a simplification is reasonable and necessary, and it must decide where such a simplification makes no sense at all, and where handing in a tax declaration, just a normal one or so, or a simplified one, can be expected reasonably from a foreigner. So where assessment is made, and where you have alternative, more simplified and less bureaucratic procedures, which are then probably less fair, probably, but on the other hand will be tolerated by the taxpayers, or even well liked, because it saves the cost of looking for a tax advisor in a foreign country. So you will find the same underlying structure and logic in every country of the world, or at least in most countries of the world. Probably there is never a rule without any exception or so. But the basic principles of limited tax liability will exist in similar way in other countries. So if you want to inform yourself about the rules in your home country, my recommendation is, well, find out which form of taxation, of tax liability exists in your country, where only the inland income is taxed as the basic idea. Think about the cases where a part of the inland income is left out from the tax. So where your home state legislator renounces on claiming money which comes from the inland but is earned by foreigners. That will happen probably. And have a look on where a regular assessment is demanded and where simplified, more brutal, or standardized approaches are made, which lead to a kind of a standardized taxation on the basis of estimates. Now, naturally, we must think also about the why. And here on the slide, you see debate that with your neighbors. Okay, that's not easily done on YouTube, but and it's not really recommendable to ring the bell in the house where you live and try to begin a conversation with one of your neighbors in the house about tax claims for foreigners or so. You will probably then gain the reputation of somebody who is relatively strange. But if you find others who are also interested in the topic, for example, on social media in other countries, it might be a good idea just to start a conversation on things like that. So let us first think about why limited tax liability only taxes income from the inland. So why do we not tax more what foreigners have? So why no worldwide taxation of foreigners? And the second question is then, why is the inland income taxed and not left untaxed? So the first question, or the first approach to a solution, comes from international law. International law says a state can regulate things which have to do with its territory, or it can regulate all what persons do who have to do with that state, so who have a connection with that state. So a state can extend its laws to either what happens in its territory or to persons, for example, having its citizenship or living in that country. Now, with persons living outside the country, you can, under international law, only regulate things, their behavior, which has an impact on your own territory. The general rule is a state is not allowed under international law to apply its law to something which has absolutely no connection with that country. And so you need either a connection concerning the event or a connection concerning the person. With foreigners, with people living abroad, you don't have a personal connection, so it must be a connection concerning the income. Otherwise, taxation would not be, or taxation or application of laws of the inland would not be allowed. So now let's come to reason B, the economic aspects, why limited tax liability exists and why you can't leave untaxed the income of foreigners in the inland. The reason is just and simple fair competition. If someone can earn money in your own country without paying taxes, it is possible that that person is also lowly taxed in his state of residence. And then it might be that that person can accumulate a far higher net profit than your people can do. And so the enterprise of your foreign competitor could flourish more easily and with more success than that of your own people. So you would allow foreigners to set up a fixed place of business, a shop or so, in your own country, and give them better chances than to your own people if you leave them untaxed. That would lead to the consequence that you just bring your own people in the long run out of the market. And that is something which no state can tolerate. For example, the same with houses in the inland. Imagine for whom would be buying houses in the inland more attractive? For the ones who have to pay, let's say, 50% of the rent income to the fiscal authorities, or to those who can keep, let's say, 100% or 99% or so, because they only are paying taxes at home, and there the tax is either non-existent or very low. Then naturally these people could offer higher prices for inland houses, because for them they are more attractive. They bring a higher net revenue than to the inland potential buyers of such houses. Furthermore, they could accumulate money more easy and more quickly. So if somebody has already 4 houses in the inland, accumulating the necessary money to buy a 5th house would be possible far more quickly than for inland taxpayers. And all these aspects of competition and fairness lead to the conclusion that you can't leave the inland income of foreigners untaxed. Good. So at least all income which is relevant for reinvestment, which is determined or might end up in reinvestment in a business or other inland investments, all these cases can't be left untaxed. Otherwise, you would have strong distortions of competition, and so you would have to tax it. Otherwise, you would even have drastic consequences. For example, tax consultants would tell your own people, your shop in the inland can only flourish if you move your residence abroad, so if you leave the country. That would have strange consequences. If you want to be a successful entrepreneur, if you want to be a patriot and do something for the economy of your country, then leave that country, because otherwise you would have to pay taxes and your enterprise cannot survive. That is something, that's a constellation which no state can ever tolerate. Now, let's think about the second phenomenon. Not every inland income is really taxed by limited tax liability. At least that's the case here in Germany. So let's look for the why. So for the reasons behind that, why are there potentially some gaps? Example number 1 here says, let's imagine you have a share in a German company, and that share is now sold via the stock exchange in New York, and the seller is a US citizen and the buyer is another US citizen. Now, under international law, Germany might levy a tax because the share is in a German company. So the event has a very, very far-fetched connection to the inland, but that would justify to apply German laws to that transaction. Why? And the answer is, think about real life. How could you ever enforce a tax claim on a share, a single small share in a German company which is sold in a foreign stock exchange between 2 foreigners? Would be entirely unrealistic. The only thing which you could gain by this would be you would have a potential criminal offense reproach against all foreigners whom you don't like. So you could probably accuse every foreign politician or business owner of breaking German tax law at your own discretion. Probably the reproach would always be true. And in the long run, that would only lead to one reaction. The New York Stock Exchange would refuse to allow the trade in German shares because the risk of a criminal offense would be regarded as too high by them. So you would just cut off your enterprises from the foreign capital markets. So that's a good reason to renounce on such a tax claim. The same now, the share in the same German company is now sold via the stock exchange in Frankfurt by a US citizen to another US citizen. Here, you might even have some people in the inland who might know about tax claims and might be able to enforce them. But then, if you renounce on taxing shares which are sold in New York, but then tax them if they are sold in Frankfurt, then you would just create a competitive disadvantage for the stock exchange in Frankfurt, because then foreigners would only buy at a foreign stock exchange. Makes no sense either. So forget about that too. That explains why this would probably be untaxed. Another thing is, imagine there is a firm which sends books and other things to private buyers, and it is called Bamazon and is located in Luxembourg. And this Bamazon corporation now delivers a book via mail from Luxembourg to a German private customer or to a German customer, whatever. Now, under international law, Germany might claim a tax because the event touches German territory, the German market. But if you read paragraph 49 ESDG, that does not happen. We don't raise a tax claim there. Now, what can be the explanation? And the answer is, think about it again. What would happen if you demand tax on a business profit from a foreign deliverer? Well, that person here, the Bamazon firm, would be obliged to declare that single sale in a tax declaration and compute their profit according to German tax law. So the sales revenue minus the variable business expenses minus an appropriate share of the fixed costs referring to that single transaction, and naturally that cost accounting affair would have to be done according to the ideas of the German fiscal legislation. So different from the Luxembourgish approach, and that would require a completely new cost accounting, completely new assessment of all revenues and expenses made in Luxembourg, in the Luxembourg firm, in order to be able to calculate the profit from that single transaction. And there is only one reaction possible. The firm would just exclude German customers from their offers. Nobody would ever tolerate the bureaucratic efforts that one should have to calculate, again, under a foreign law, the profit which results from a single transaction. Far too much bureaucracy. So if you raise a tax claim on a single transaction which is made from the outside to the inland, then the effect is probably that you just cut off yourself from trade relations with the outside world, and that is a good explanation why in the whole list of section 49 you will never find a tax claim on a single trade operation, delivery of a single good or rendering of a single service from the outside world to the inland. It's just not recommendable. Now, the same principle, a firm in Luxembourg takes in order to renovate a building in Germany. The employees drop into Germany and work here for 4 days. Now, why don't you include the business income from that single operation into the German taxable inland income of that foreign firm? And the answer is again, otherwise, if you did tax it, they would never accept the German order. So you would also then never get that money. So under international law, raising a tax claim would be possible because it has to do with the inland, but under economic aspects, it's not recommendable. Now, the other extreme would be a taxpayer who lives in Liechtenstein. There, the tax rate is only 12%, at least rumors say so. I never guarantee for things about that. And now owns a shop at Kleve that is in Germany, as you know sufficiently. And the shop generates a profit of 500,000 per year. Now Germany can naturally tax that, and now Germany does it. Why? Because now this is different. Now our taxpayer has a stable relationship to one place in Germany. There you have costs related to that fixed place, the cost of the house of where that shop is in, the personnel costs, so for the staff, well, the depreciations for the shelves and all that stuff. Here you can set up a different cost accounting for everything which happens in the shop at Kleve. You don't have to redo all the bookkeeping events which relate to the head office in Liechtenstein. Here you have a separate entity, or which can be viewed separately. Permanent establishment, as it is called, a fixed place of business, something stable for a long time, which is situated in the inland and where you can determine a taxable profit separately from the rest of the enterprise, so where it can really be done. And here it should be done, because otherwise, if you don't tax that shop, you end up again with the competition problem that this shop could generate a higher net income and so could retain higher earnings than the inland competitors. And so in the end, they would have a high advantage over their inland competitors. And that is something which you can't tolerate. So we end up, for example, in an idea which says us single transactions by a firm outside of your own country should not be taxed for economic reasons. On the other hand, firms or parts of a firm which are located in your country should be taxed, again, for economic reasons. And that ends up with, where do we draw the line? That's the all-important question. So what is a single transaction from the outside to the inland, and when do you have a firm or a part of a firm inside your country which you can't ignore anymore, and where the need for simplification is no longer given? And the solution is, well, you should draw the line where somebody establishes a part of the business permanently in the inland. So that is called a permanent establishment. Perhaps you have already heard the term. A permanent establishment is a fixed place of business or a fixed place or some devices where the activity of an enterprise is undertaken with. And the principle that you now can formulate is, wherever a permanent establishment is, their estate will in all probability not ignore that permanent establishment and will subject it to limited tax liability. On the other hand, in most cases where a business does not have a permanent establishment abroad in another country, there you cannot or will probably not tax the operation, the deliveries or services to that other country in that country. So foreigners will probably be taxed if they have a permanent establishment in the inland, and if it's a business operation and they don't have a permanent establishment in the inland, then it will probably not be taxed. That seems to be a principle which is followed by many, if not the very most countries in the world. So the permanent establishment principle has two parts. first, where you have a PE, permanent establishment, you will have to pay taxes. Where you do not have a PE, you will, in all probability, do not have to pay taxes. Good. Permanent establishment, just to bring that back into your mind again, because it's a very important term, is a fixed place of business. So office rooms, a fabrication plant, a shop or so. And naturally, you need in the law a clear definition of what already constitutes a permanent establishment, and that is in Germany in section 12, paragraph 12 of the Abgabenordnung 12AO. There you find the definition, the German definition of what is regarded as a permanent establishment. Okay. Well, let's go on, or let's go back to our question. Within the limited tax liability, some income from the inland is taxed, some other is not. Again, let's think about the why. Example number 4 confronts us with a new constellation, now from employment income. A worker has a job in Kleve again in Germany, so yeah. But he lives in the Netherlands. Okay, that's not so far away from Kleve, so it's understandable that somebody has some job to do at Kleve. Should we tax that worker or not? The answer is, well, in my constellation here, the worker has a job here, so is evidently employed by a firm at Kleve. Now, what would happen if Germany did not tax the job income of such a worker? Well, I can promise you one thing. If I had a job at Kleve and I were not taxed if I don't live here, then I would easily move to the Netherlands and set up my private residence 10 meters beyond the border, just in order to escape German taxes. At least if the Dutch taxes were a bit lower, that would be definitively my approach. And so, you see, probably no country can afford to tolerate that people have a permanent job in the inland and are not taxed. And by the way, what would that have as consequences for the gross wages? Imagine somebody from Germany wants to have 4,000 euro gross income for a job, then somebody living in the Netherlands comes and is willing to work for 3,500 because that Dutch job applicant could keep a higher net income, perhaps. So that's a clear thing. No state can tolerate this. Foreign applicants would undercut the German applicants in their demands for how high their wages should be. And so the answer is no. You can't ignore that. If you have common sense, you will have to tax that. Now let's vary the situation a bit. Now our worker lives in the Netherlands. His employer's firm is now also based in the Netherlands, but our friend comes to Germany from time to time, for example, for 3 days in a year. Now our worker works in Germany, but only for 3 days. Should we levy taxes or not? And the answer is, how high is the danger that here damage is done to the German economy? And the second question is, how high is the bureaucracy? So would we really want that a foreigner has to apply for a German, or to look for a German tax advisor, pay him for helping in the German tax declaration and all that stuff, only because he or she worked 3 days on German territory? And the answer is no. And the more drastic consequence would be the worker would probably refuse to work on German territory. So if you need a craftsman or somebody who is going to repair something in your house and you only find some supplier in the Netherlands, then the workers, the employees of that supplier, would probably refuse to work in your house because that's in Germany and they don't like to pay German taxes. The same might be true with 3 weeks, might even be an affair of 3 months that somebody stays at home. 3 years, oh, I think there we should already have drawn the line that somebody who drops into a foreign country for 2 or 3 years or for even a complete year, that's so important. Yeah, there having to look for a tax advisor in the other country probably can be demanded, can be expected that somebody does it, or that the firm sending that person there on such a constant basis takes care of the necessary legal affairs combined with that posting of that person to a job abroad. Here we see that probably that taxing foreign workers depends probably. It requires some discretion. What can we afford without ruining the business transactions so that people refuse to do the jobs in Germany? And where do we have to levy taxes? Because otherwise we would do injustices to our own job holders resident in Germany. The solution in Germany is, by the way, if you read paragraph 49, number 4, correctly, that Germany just has no minimum period of a stay in Germany. So in our law, even income from employment by a foreigner achieved in the inland is taxable even if that foreigner only worked in the inland for 10 minutes. That can only work in real life because Germany has concluded many double taxation treaties. And one of the first things which we always do in a double taxation treaty is we renounce on the taxation of the income from employment from people who only drop in from outside Germany for a very limited amount of days during a year. If they have their residence abroad and their job abroad and only come to work here for 10 minutes, 3 days, 3 weeks, or even 3 months, that will be ignored. The usual clause in the double taxation treaties is if a foreign worker does not drop into Germany for more than 183 days within a period of 12 months, however these 12 months are measured, then the job income will not be subjected to German tax. But again, this is only some tolerance which we show if there is a double taxation treaty. If there is no double taxation treaty, so for example, if you live in Monaco, the principality lying south of France at the Mediterranean Sea, where all the rich and influential people live, if a worker living there comes to Germany and works here for only 2 days, that would be taxable under paragraph 49, because with Monaco, this tax haven, we have no double taxation treaty, and by the way, we do not intend to ever conclude one. So no 183 days rule in the basic rules of limited tax liability. Keep that in mind, at least when it comes to German law. So for people coming from non-DTT countries, it's highly dangerous to enter German territory during their working time. They will end up as taxpayers in Germany. Most of them, by the way, never find that out, and most of them never are found out by the German fiscal administration. At least they should not post their adventures during working time in Germany on fiscal networks, on social networks where the fiscal authorities have registered as followers of them. Okay, yeah, again to the question. Some income from Germany will be taxed as inland income under limited liability, other will be ignored. Well, another constellation might be interesting. imagine you have a German firm and you want to get work done by 100 employees. Now, if you choose German employees, the wages will have to be gross wages, because they will demand wages which are sufficient to pay the taxes and to live from the rest which is left over from the net income. Now, one of your managers is a very clever person, and proposes, let's just employ 100 employees in the foreign state of nearly have no tax, a country which nearly has no tax, but only a tax of 1%. So the employees will work there, the work will be done there, and the result will be carried to Germany, the result of their work. Now, under international law, you could conceive the idea, justify the approach to say what these people do in nearly have no tax has to do with the German market, because they are working for the German market. The result of their work is transported to Germany, so that is a sufficient connection under international law. We should tax them. Well, economically, indeed, the idea is not complete rubbish, because here these 100 employees in nearly have no tax really compete with German employees. You take them as a replacement for jobs which otherwise would be created in Germany. And so German law indeed says in its rules on income from employment from the inland that as income from employment in the inland, connected with the inland, also counts the income from jobs done abroad if the result of your work is then transported or transferred to the inland. By the way, that happens rather rarely. That's the first consequence. And second, very often the German fiscal administration does not follow up that theoretical tax claim, because it's usually in practice you cannot really enforce that tax claim. Also, this is one of the tax claims which is immediately dropped in a double taxation treaty once when we conclude one. But this is only a kind of basic rule which is evidently meant to prevent such extreme constellations like the one which I imagined here, that 100 jobs here are just lost to a foreign country just because of and only of the missing tax on the wages. Yeah, a foreign writer writes a book, what writers very often do, and earns money, what writers very rarely do, from the royalties paid by Germans. The money is enough to live from it for the next 3 years. Should the amount be taxed or no? I could think about it. That's a question of a debate. One could say, well, if there is some money which we can tax, perhaps, why not? Here you probably have somebody in the inland transferring the money on the foreigner's bank account. You could say he earns that in the German market from a German business partner, and so we might think about taxing it. Good. The houses in Germany and so on, you can always think about, makes it sense to tax it or not. So in the end, when we look to the list which finally comes out in paragraph 49, section 1, ESDG, you see there assorted according to the well-known 7 types of income in Germany. Number 1, income from agriculture and forestry is taxable if there is a permanent establishment for income and forestry in Germany. So if, in plain words, you have a farm or a similar thing on German territory, the income from that is taxable here. Good. If you have a business, then the main case where you are taxable in Germany is if the business is undertaken by you by a permanent establishment which you established in German territory. Also, if you have a permanent representative in Germany who is entitled to conclude contracts for you, because that representative could be a way to avoid the establishment of a permanent establishment of your own. And so it's a kind of a necessary completion of that rule. But in reality, the permanent representative is relatively rare. The permanent establishment is what really counts. Letters B and C are rare things which we can leave out here in a beginner's course. D is something interesting: income caused by public performances by artists, entertainers, and similar people. Especially what? No, let's express it differently. The important thing is here that income must be a business income. Now, a foreign pop singer usually is an artist, so that would be income from self-employment. Now, and that's always taxable. We will see that if self-employment is exercised in the inland. Now, the income caused by public performances is not only the income of a singer or the artist himself or herself, but this is also the income which somebody else derives from organizing or supporting such a public performance of an artist in the inland. So if you organize a concert or so in the inland, your profit from that single concert would be taxable in Germany. The reason is, as that is a very usually big event, and as here this is a relatively clearly defined inland business transaction, you can calculate that more easily than other things, and so there is a tax claim. If you sell shares belonging to a major participation in an inland company, that is classified under German income tax as fictitious income from business, and so this category also shows up here under number 2, under the category income from business from the inland. If you hold a participation of more than 1% in an inland company, in a company which is subjected to unlimited tax liability in Germany, then selling the shares will be taxable under limited tax liability. If you have a foreign firm and that firm owns buildings in Germany but has no permanent establishment here, or if that firm gets other income from lease and rent from Germany, then you know that income from lease and rent, if it can also be viewed as income from business, would be reclassified into income from business. This is a main type of income, and lease and rent is an ancillary type of income. So if you can use the both levels for the same event, business income usually wins. And so just to close the gap, income from lease and rent is also taxable if it is made by a foreign business person with objects in Germany. The difference, by the way, is if you have a foreign GmbH, for example, as the owner of an inland building. If you subsume that under the headline income from lease and rent, then it would be private property, and then selling that building after more than 10 years would be tax-free. And that would be a competitive advantage over business investments made by German businesses on German territory. And to close or to remove that advantage, it has been decided that income from lease and rent received by a foreign business person, especially by a foreign corporation, is then also classified as income from business, because then the tax-free sale after more than 10 years is also not possible. Income from self-employment is always regarded as inland income if it's executed in Germany, so if the services are performed here. If the result of the work is transferred to Germany, So you write a book and then give the right to print it to a German publishing house, that would classify for that. Or if it is connected to a permanent establishment of somebody in Germany or of your own, better of your own in Germany. Income from dependent work, if the work is done in Germany, if the result is transferred to and used in Germany, and if it is paid for by a German public institution, and some other minor cases. Income from capital is income from dividends, if paid by a juridical person subjected to German unlimited tax liability. So dividends are regarded as inland dividends if the payer is in the inland. Interest income is taxable if it is secured by a mortgage on German real estate property, and only then. And some other very rare cases which in real life probably do not happen. Lease and rent income, if immovable property is situated in Germany, if you let a complex entity, a multitude of things forming a new complex entity together under economic aspects, usually a firm. In Germany, if you let that for rent to others, or from rights which are registered in Germany or which are used by a German firm in its German permanent establishment. Then several items which are usually classified under other income are listed individual from number 7 in paragraph 49(1) onwards. We don't bother about that here too much. Now there is some peculiarity. You know that basically under unlimited tax liability, there is always that conflict that sometimes an event can be labeled in two different things. For example, the interest received by a bank could be regarded as income from capital, its interest, or as income from business. And the usual rule is that income from business as a label always wins. Now, within limited tax liability, that would be, from the view of the tax legislator, rather self-destructive, because imagine a bank gets interest from Germany. As income from capital, it would not classify for tax. And as income from business, well, it would only classify for German taxation if it were received by a German permanent establishment. So would be no tax claim. Dividends paid by a German GmbH are normally taxed, but if they are received by a firm in London, if you then reclassify them as income from business, then they would only be taxable if they are part of a German permanent establishment, and they would not be because they are collected in London. So they would drop out of taxability. That is what the law wants to avoid. That rule that if there is two labels possible for a single transaction, that then business income prevails, that is meant to enlarge the tax claims. They also want to have a claim to the sales of the property, and they want to have a basis to demand trade tax. Now, where the prevalence of business income over other types would lead to a complete loss of the tax claim, that makes no sense. And so paragraph 49, section 2 says, in a very, very complicated way, no, the prevalence of the business income label over the other types of income only applies if that does not result in a loss of tax claims. So only when it is favorable for the fiscal authorities within limited tax liability, not if otherwise a tax claim would have to be denied because it is business income, but only business income of a foreign permanent establishment. So, for example, if an English firm gets a dividend from a share in a German company, that would not be covered by income from business in section 49(1) number 2, because it is not a part of a German permanent establishment's profit, and it can also not be found in the other letters of paragraph 49(1) number 2, but the case is still covered by the label income from capital, and so we can tax it under that entry, and that will be done then. The idea 49(2) is always that you, to say it in plain words, check the catalog of 49(1) until you find something which can justify a tax claim, and only if at the end of the catalog you have found no entry at all which could justify a tax claim, then no limited tax liability is given. Okay. Now, a next important aspect, which we mentioned in the beginning, the taxation of foreigners is often to be simplified, but not always. There are two ways how you can collect a tax. First, by demanding a tax declaration and assessing the situation, issuing a tax notice to the taxpayer, which then tells him or her what they have to pay. Or you can also tax somebody in a simplified way. You look to the revenue which goes to that person and demand that a part of that revenue is directly handed over to the fiscal office by the person who makes the payment. For example, you perhaps know that in many states there is what in Germany is called Lohnsteuer, a wage tax. So if your employer pays you your wage, then, for example, if you have to get 1,000 euro, the payment which is to be made to you is split up. Let's say your prepayment for income tax, the wage tax, is made by your employer on your account at the fiscal authorities, let's say 200, and the remaining net amount of 800 will be transferred to your bank account at your bank. So such a tax where a part of the revenue is withheld from you and directly transferred to the financial authority, to the fiscal authorities on your behalf, is called a withholding tax. And that is a very convenient way to tax foreigners. So sometimes this way is chosen. For example, Mr. F from Faroestan has to get a license fee of 1 million euro from a German businessman. Now, German tax law demands that the business friend GB has to split up the payment and pay it onto two different bank accounts. An amount of 15%, that is 150,000, and at least during the next times, still 5.5% of that as a so-called solidarity surcharge, 8,250, have to be withheld and have to be paid to the bank account of F with the fiscal authorities, so on his tax liabilities account at the German tax administration. Only the rest has to be paid to the bank account of F. So that's relatively easy, because this way the state can make certain that they get at least an amount of 15%. Let's forget about that solidarity surcharge now for reasons of simplification, that the state can get 15% of the revenue as payment, because, well, once when the money is abroad, it's difficult to enforce a tax claim against somebody who lives abroad and just got the payment and then has nothing to do anymore with the inland. So there will be cases where this plain and simple system just make a withholding tax, where that system is chosen by a legislator, and other situations will be there where the legislator says, no, there a withholding tax is not an adequate measure, rather inconvenient. So there we stick to the traditional method of demanding a tax assessment. Well, so in principle, the two possibilities exist everywhere, but naturally different countries will choose different solutions, not the identical ones, and they will not always make the choice between an exact assessment by tax declaration and working on it, or withholding tax in the same way. But you can expect at least certain similarities, because everywhere where you have similar problems, adequate solutions are often also similar. Now, let's have a small look on where Germany practices, for example, such withholding tax. Think about a German GmbH which pays a dividend of 100 euro for a very small share to a taxpayer living in faraway Eastern. Now, 100 euro. Can you really expect that such a taxpayer makes a German tax return, a German tax declaration? Probably no. Can the German fisc really enforce him to pay if he doesn't want to? No, probably not. In faraway Eastern he lives, and that is far away, and so you won't get him. So many aspects here speak in the favor of a withholding tax solution if the dividend comes from a German company, which it does by definition. You have a pop singer getting a wage of 100,000 euro for a performance in Germany. After 3 days already, the pop singer has gone away again. And as he is a pop singer, there is a certain probability that after some time he will have spent all the money for drinks, parties, and drugs and such stuff. Or lost it in the stock exchange, which is rather the modern way of ruining oneself. One does not know. There is only one thing which is relatively certain with an artist, an entertainer, or other people like that. There is a high probability that they are not really the kind of excellent bureaucrats who take care of their tax liabilities and put away the money decently, especially not if it is about the tax claims of foreign countries. They probably don't know. So it's highly unrealistic that you really can expect that pop singer to make a German tax payment. It is probably not possible to force him when he is back abroad to pay German taxes. So many aspects here speak in favor of a withholding tax solution. On the other hand, imagine you have a limited taxpayer. Here his name is LTP. From the Federation of Mostly Unknown Republics, Kingdoms and States, MURKS works. That guy is the owner of a shop in Kleve, and now there is a question if we can take a withholding tax solution. With a withholding tax, everybody who makes a payment to the taxpayer has to split the payment and pass on a bit of the payment to the fiscal authorities, which then book it on the tax account of the person in question. Now imagine in that shop, every morning some 20 people drop in the first hour and buy something, for example, a bottle of milk. And now when at the cash desk you are told that you have to pay 1 euro, then you would have to split the 1 euro up into 15% or whatever has been determined as withholding tax rate, which you keep and at the end of the day transfer to the fiscal authorities, and the 85 cents you give to the shop. That makes absolutely no sense. That's not practicable. And so in such a situation, you would just say a withholding tax solution wouldn't work. And in addition to that, a withholding tax solution would also not be necessary. Who establishes a shop in a country is very often and in many kinds and aspects confronted with the local law. That person has staff from there, that person will have to make a bookkeeping there, that person will be able just to cross the street and then find a tax advisor there relatively easily. So indeed, withholding tax solution would be inconvenient here, and assessment solution is feasible here, can be made, and so our prognosis will be, in all probability, there will be an assessment solution here. Probable example number 4. Taxpayer G lives in the Federal Republic of Jersey. Jersey is a state which is completely similar but less populated than Germany. And the Jersey taxpayer is the owner of a building in Bonn, which is in Germany. And from this building, he gets income from lease and rent amounting to 12,000 euro a year. What would you prefer if you had to write the law on your own, a withholding tax solution or an assessment solution? One might think of a withholding tax solution, but think twice. For example, in that building, you have several flats, and they are rented to a student, a 90-year-old school teacher, a stranger who is not familiar with the language, and some strange people. For example, university professors, which are, as we know from personal experience, at least you know, which are completely mad and can't be trusted with anything which has to do with real life. So now, if you were the German tax administration, what would you think? Would you really think it's easy to say, okay, every one of these, let's say, 4 people in that house splits his or her 250 euro each month into a share for the fiscal administration and a share for the landlord? And do you really believe that could work? Or alternatively, you just expect that the landlord learns to hand in a tax declaration. Well, we can reasonably assume that the average citizen living in such a room, which is rented, has no sufficient ideas of German tax law, so it would go wrong. Would go wrong to rely on a withholding tax solution. And now the question is, well, can we rely on, or can we reasonably expect that a tax declaration from the foreign owner comes? And the answer is, well, if the foreign owner doesn't care about the tax declaration and you find it out, can you obtain your money? And the answer is, well, there is a house. And the house is immovable property, so you can't get it away from the inland. So if the fiscal authorities detect a tax claim referring to the rent from that house, they can, as a matter of last resort, always confiscate that house. And that is probably sufficient to cover the tax claims for 10, 15 years or so, whatever has been overlooked as a period during which the owner had to pay taxes on rent income. So the tax revenue there is not really in danger. And I can guarantee to you that probably the existence of a house will not be completely overlooked by an authority of the state for a long time. That is just not realistic. So here, many things speak in favor of an assessment solution. Yeah, so in principle, if you compare the assessment solution versus or with the withholding tax solution, then you can see an assessment can be prescribed, where a tax declaration can be expected, and where tax claims are also safe enough that you can enforce them in the inland. Whereas in case of withholding tax, that should usually be the better solution if the taxpayer can be expected to have no sufficient tax knowledge. and or alternatively where there is no reasonable chance to enforce the tax claim after the money has once been paid up. Now, think about the withholding tax solution. Would it make sense to say we practice a withholding tax solution and then afterwards demand later a final tax declaration from the foreigner and then assess the tax correctly and ask for the remaining liability, or we give back the excessive amount, the exceeding amount of the withholding tax by which it exceeds the amount which would be normally due under a tax assessment? And the answer is, well, we just introduced the withholding tax solution to make an assessment superfluous, unnecessary. So that would be spoiling the whole main aim of the whole procedure. So very often you will see the case, although you will see the principle that when foreigners are taxed under a withholding tax solution, then the withholding tax is very often by states declared as definitive, so that a tax assessment is not necessary, so that you can never be accused of tax fraud if you don't try to hand in a tax declaration, which usually is natural because you will normally not know about foreign tax obligations and if they apply to you or not. So that would be easy. One could then think about if a tax assessment could be granted voluntarily to others, but that's a question if the fiscal administration then thinks, well, we want that simplification also for us. We don't want to write letters in a complicated way to people living far away in the world, which do not understand our letters and then are problematic conversation partners. So just to give an overview about typical examples for an assessment solution. Assessment solution is probably to be expected with permanent establishments like the shop, because there are many customers, so splitting the payments would be not practical, and it's not necessary because here you have fixed assets and other things in the country which cannot be easily removed, so that you have also a certain guarantee that tax claims can be enforced by confiscating property in the inland. Immovable property, the same. Withholding tax solution is a good candidate for the treatment of dividends, interest payments, license fees, wages for artists and entertainers, and perhaps the one or other occasion where the fisc fears that the tax might be in danger. By the way, in the German rules on limited tax liability, there is even an option for the fiscal authorities that when they know that a limited tax liability taxpayer is going to get a payment from somebody in the inland, where they fear that the tax obligations might later not be realistically fulfilled, that they can order the inland business partner of that person to apply a withholding tax on all those transfers of money which they specify in their order to that person. So in German law you have some provisions on withholding taxes. In 50A ESTG you have a list of withholding taxes which have been introduced especially and only for payments to limited taxpayers. They amount to 15% and in some cases to 30% of the amount paid. And apart from that, also those withholding taxes which are to be applied in general, that is also when you make payments of that kind to an unlimited taxpayer. Also, these are to be applied in a cross-border relation. The capital income tax, called Kapitalertragssteuer, levied with 25% on interest and dividend payments. So whenever somebody in Germany makes the payment of a dividend or of interest, you have to split the promised 100 euro or so, and you have to pay that in on two different accounts of the recipient. 75 or so go to the bank account, and 25 go to the account of the recipient at the fiscal authorities. The same with wage tax. That's applied to every payment of wages and salaries and similar remunerations. And there the rates are computed according to individual situations. Or if somebody has to do with building activities, there is also a building activities withholding tax. The German term would be Bauabzugssteuer. It's 15% of the gross amount of the payment. So the net amount which you have to pay plus the VAT which comes on top or is included, and from this you have to calculate 15% and have to withhold that and transfer that amount to the fiscal authorities. All these rules are basic rules, and one of the principles here is nevertheless that if special rules allow a deviation in general, for example, there is a double taxation treaty which says a license fee which is paid to a recipient in, let's say, Mexico cannot be taxed in Germany, then nevertheless the withholding tax duties have to be fulfilled, so 15% have to be withheld in all cases where the fiscal authorities have not explicitly confirmed that this special payment to this specific person in that special case and state is under a special rule possible, free of tax or at a reduced rate. In all other cases, you have just to stick to the standard rules, withhold the withholding tax, give the recipient a certificate, an attestation that you withheld the tax, and then with that certificate or attestation, that foreign recipient can approach the German fiscal authorities and claim a refund if he or she proves to be entitled to no taxation in Germany or to a lower taxation in Germany under a double taxation treaty or under any other rule. Yeah. What I already mentioned is that withholding taxes are in most cases conceived as definitive. So after the withholding tax has been taken, that event is taxed and gone, finished, has no longer any relevance for the tax treatment of that person, even if for other reasons such a foreign taxpayer would have to hand in a tax declaration, for example, because that person still has income from leasing rent from a house. So that event would have been definitively taxed after the withholding tax was taken. You can find this principle laid down in paragraph 50, section 2. I believe it's sentence 1 there, which states, okay, apart from some exceptions which are listed immediately afterwards, the withholding of a withholding tax is definitive and closes the taxation of that specific event for the foreigner. The same rule applies to foreign GmbHs and AGs, so to foreign juridical persons, but there the reference, the source in the law is a bit different. There it's paragraph 32 and section 1 in the KStG. Exceptions are possible where a limited taxpayer in rare situations can voluntarily apply for an assessment, or in very, very rare cases where an assessment for a foreigner is, even in such a withholding tax situation, mandatory, so is an obligation. For you, it might be interesting if you inform yourself about the tax treatment of foreigners in another country than it, for example, in your home state, then it is naturally interesting to find out which withholding tax obligations exist in your home state legislation, and how high are they, and so. And whatever you can find about withholding taxes in USA, GB, France, and other countries, try to find it out, try to remember it for the future, because that is interesting insofar as when you expect a payment of 1 million from that country and you have made a contract which entitles you to 1 million, is not always guaranteed that really 1 million will arrive on your bank account. There might be a big surprise that only 850,000 arrive on your bank account, and you are puzzled and ask yourself, what's now with the rest? So that might spoil your whole liquidity planning if you don't know about that. And if there are any possibilities to avoid that withholding tax in advance, or if there are papers to be filled out which entitle you to a refund of a part or all of the withholding tax, then you should also know about, or in before already know, that there is a withholding tax applicable, so that you can look for the necessary papers and have them at hand quickly after the payment has been made, or even file or apply for a certificate of tax exemption or tax reduction in advance to the foreign authorities. So knowing about withholding taxes is really interesting when it comes to cross-border relations. If you look to the legal sources, you will find out that the rates of a withholding tax are usually considerably lower than the rates on which are levied on the income of unlimited taxpayers. And that has a reason, because 15% on the revenue is something completely different than 45% on the profit. The profit is revenue minus expense. That can be a very low amount of money. So 45% on 10 euro, or if you get a revenue of 100 and have expenses of 90, then you have a profit of 10. And your income tax at 45% would be 4.5. But if you get 100 and you are taxed with 15% on the revenue, that would be 15 euros. So the 15% for the foreigner can be far more than the 45% on the profit for the person in the inland. What is more favorable just depends in the final effect on the amount of expenses which you have. So you cannot in general and for all cases say that the low rates for the foreigners are always better than the rates for the inland taxpayers. And on the other hand, you can also not say that they are always worse than the tax burden which is demanded from the people in the inland. There, usually the tax legislator has just to make an estimate how much expenses will reasonably be underlying such a revenue, so that we can make kind of an estimate which is perhaps at least approximately fair. Okay. Now you must see that in extreme or in certain situations at least, that withholding tax regime can create drastic economic disadvantages or consequences. Imagine there was a certain amount of years ago a pop singer who planned a concert in Germany. He was going to earn 1 million euro. That was not the real figure, but I choose that figure to simplify life. His cost, let's imagine that will amount to 900,000 euro. So the concert will be rather a success. Expected profit is 100,000. But then our foreign singer gets the information Germany levies the income tax by a withholding tax regime and demands 15% of the payment made to him. So 150,000 will be The simplified way, or the estimated amount of tax on his income, and that tax will be definitive. So no change will be possible. So no exact calculation of the profit and no exact assessment possible. Tax is just estimated to be 150,000. Justification of the fiscal authorities, well, in some cases that will be too much, in other cases that will be too low. That depends on the individual situation. We can't find that out, far too complicated for us and for the foreigner. So 150 is okay, and it's 150 whatever happens. In that case, you have now the drastic situation. 150,000 have to be paid, 100 is your profit. So that would be 150% of your income. And if you hear about this, there is only one natural reaction. That famous pop singer stopped the project and canceled the tournée through Germany and all the concerts he had planned for himself. That explains why sometimes the taxation is regarded as unfair by limited taxpayers, and why sometimes there are possibilities where one allows them to opt for an assessment, or even to opt for the application of the rules of unlimited tax liability to their German taxable income. The difference, by the way, between a regular assessment as a limited taxpayer and an assessment under the rules of the unlimited tax liability is that within the unlimited tax liability, you can deduct special expenses and extraordinary expenses. That is nearly completely impossible within the framework of an assessment as a limited tax liability taxpayer. Very often, due to that drastic economic consequences, the European Court of Justice has made jurisdiction based on the principle of non-discrimination, which says that citizens of the EU, of EU states, may not be discriminated against by legislation of a member state if they are in the same situation as a citizen of that member state and there is no explicit or implicit justification of a different treatment. So if there is not a really compelling reason to make a difference, and the wish to simplify life for the administration is not a compelling reason, otherwise the world would not break down. And if you want to simplify bureaucracy, then the European Court of Justice says, well, if you want to simplify treatment of tax cases, you can do it, but then do it for all taxpayers in the same way, so for the Germans and the non-Germans, or renounce on it and make exact assessments, but then do it for the Germans and the non-Germans, because if you want to simplify bureaucratic procedures, there is no compelling reason why that should only be done with regard to foreigners, at least if that is to their disadvantage. So under that jurisdiction, very often it has been accepted or granted by European Union jurisdiction that certain foreigners can appeal for a tax assessment under limited tax liability regarding to the limited tax liability income in Germany, according to the non-discrimination rules. Now that gives us a mass of rules to check, and there is no official testing scheme how one should approach a case. According to my personal experience, The testing scheme, which I just placed here on that slide, is a very good thumb rule to approach a case. It is a very good way to muddle through a case and in the end to have found everything out which is relevant. You should begin with the question what the personal tax liability is. Is that somebody who is subjected to limited or unlimited tax liability? So for this you have to test the usual paragraphs in the Income Tax Act or the KSTG, and limited tax liability will come out under the rules of 1.4 ESTG or the rules of 2(1) KSTG. Then it comes to looking at the events, so at the different amounts of income or at the different activities which the taxpayer does. And here you should follow up to 5 testing steps for each event and test one after another completely from the beginning to the end. The first should always be, is the activity which is mentioned leading to taxable income under 49 ESTG at all? For example, a foreigner wins in the lottery. Well, no income from the perspective of German ESTG, so that event is already irrelevant. Somebody inherited. No, that's no income. That's a case for the inheritance tax. Somebody runs a business in Germany by a shop. 49, 1, number 2, letter A. Look it up, by the way, from time to time at home when you have some time. A shop would be taxable income under 49. Then the next question is, how is the tax computed? Via a withholding tax or not, or via assessment? So the next question is there a withholding tax? You have here a list of the legal sources to check. If there is a withholding tax, is it definitive? That is usually basically the case for all the withholding taxes apart from the building activities withholding tax. Can you remove the definitive effect of the tax by a tax assessment? Or can you alternatively reduce the amount of withholding tax and get a refund, or can insist on a lower withholding tax rate just in the beginning already? And the last thing is, how is that event treated in case of an assessment? Well, if a withholding tax was definitive, it's clear that the whole event is left out during the tax assessment. It does no longer count because it has been definitively dealt with. In other cases, you would have just to find out, will it be added up to the rest of the taxable income of the taxpayer? How will the tax rate have to be computed on that? What goes to the assessment? And so on. And in the end, the Roman 3 number is just the catch, the rest clause. Think about if there's anything else which it makes sense to test at the end of the case before you regard yourself as satisfied with your solution. There I would store in my brain all those aspects where I made the experience that it's best to check them at the end of a case only. For example, the right to opt for unlimited tax liability if you have already under limited tax liability to pay taxes on 90% or more of your worldwide income, or if the limited tax liability extends to so much of your income that outside of Germany less than the basic allowance for survival amount is left over. This and similar things can be tested at the end. naturally, under Roman 3 at the end, one would also take a glance again at the task, which is perhaps explicitly posed under a case. Have you answered, or have you found by application of that testing scheme answers to all the questions which somebody who examines you wanted you to examine? Or are there some aspects left? And here would be the time to commend them just then and now. Now let's do some cases in order to train a bit your knowledge of how to deal with such things. Here is the first one. Consul Ting is a Chinese expert on business consulting and lives in Paris, in France. He has been elected as member of the supervisory board of the German Samst AG, a German stock corporation whose shareholders fear that the economic situation of that company could be weakened over time. So the remuneration which he could claim for his services was 100,000 euro. And the question is, how is that treated under the regular rules of German tax law? And a second question follows later. So let's have a look what we can do about that. Well, let us begin at the beginning. Personal tax liability. Personal tax liability. Oh, Consul Ting is a natural person. So ESTG applies, and neither residence nor habitual abode. In Germany, but evidently in France instead. So limited tax liability rules apply. C1 for ESTG. This has been done successfully. Second, events. Number 1 is the supervisory board remuneration taxable. Now we have to have a look at section 49. Oh, sorry. I have to reverse that. Yeah, good. We have to look at section 49. And here we will see that section 49, 1, number 3 says yes, because it has been exercised in the inland and is self-employed activity under paragraph 18 ESTG. So, taxable. Is there a withholding tax? And there, ladies and gentlemen, we should just take a look. There are several withholding taxes. Capital income tax on dividends and interest. That is evidently a no. Building activities tax, no. Wage tax, no, because the supervisory board member is not an employee. He's not bound by orders of a superior, so he is independently active, self-employed. You see, you remember last line. So we will have to look somewhere else if that can be possible, that here something is taxed. So let's again look to the tax slides collection, and here we need the ESTG, and in the ESTG we need to look in 50A. That was the thing with the withholding taxes, and here we see the income tax is levied from limited liability taxpayers by way of a withholding tax in the following cases. Income achieved by artists, and so not our case. Inland performances by artists, no. Number 3, in the case of income which consists of consideration for the transfer of use or the right of use of rights, license fees, no. Number 4, income to members of a supervisory board, an administrative council, or other bodies whose task it is to supervise the management of a corporation. That's our case. So 50A, section 1, number 4 is what we are looking for. So let's put it down. Yes, 50A1, number 4, ESTG. Now, naturally, the question comes, how high can it be? And there we should again look to the point which we just looked up, to 50A. Perhaps we can find the solution there too. And indeed, here we have our answer, which we looked for. The withholding tax amounts to 15%. In case of paragraph 1, number 4, that was our case, to 30% of the whole revenue. Then one clarification: if the person owing the consideration refunds or directly pays travel costs, these only belong to the consideration as far as the amount paid for travel and overnight stays costs exceed the costs which were effectively incurred, and the lump sums for additional nutrition costs fixed in 4.5, number 5, ESTG. Okay, that's not relevant for us. That gives us a good feeling. We can ignore that. And then there is a peculiarity referring to income defined in paragraph 1, number 1, artist wages or remunerations. Not our case, so we know everything which we need to know here and can turn back to writing. So 30% of 100,000, that is 30,000 euro, C 50A2, sentence 1, ESTG. Okay, again, we did something. Step 3. Is the withholding tax definitive? And here we have again to look to the Tax Acts, and you remember that was section 50. I have in mind that it was 52, not 50A2, sentence 1, ESTG. But naturally, one can never trust oneself, and even less one can trust the legal sources. So we will have to look it up, and we just do that immediately. And as we can see here, indeed, the income tax for income which is subjected to a withholding tax on wages, on income from capital, or due to 50A ESTG is regarded as definitively paid. Then exceptions, sentence 1 does not apply for, let's just check this for reasons of convenience, income from a business established in the inland, so from a permanent establishment. It does not apply in cases where it's later found out that the conditions for paragraph 1, paragraph 2 or so do not apply. Not our case. In cases of paragraph 2, section 7, sentence 3, so where somebody moves to Germany or leaves Germany during the year, that's not our case. Income from employment, not our case. Number 5, income from in the sense of 50A paragraph 1, numbers 1, 2, and 4. Okay, so there could be something done, but only if the assessment for income tax is applied for, and we have not yet applied. So at the moment, we can still stick to our first sentence that the income tax is definitively paid. Well, but it is going to become interesting, evidently, so let's go on reading here. In case of blah, 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 blah. Now, we see a sentence 7. Sentence 2, number 4, letters B and number 5. Number 5 was our case. 52, number 5 was the right of a limited taxpayer to apply for an assessment with the remunerations for supervisory board membership is only applicable for citizens of a member state of the EU or of another state of the EEA who have their residences or habitual abode in the territory of one of those states. So in our case, that will not be applicable because our taxpayer is resident in Paris, but nevertheless, our taxpayer is a Chinese taxpayer. So the citizenship of a member state of the EU is not given, and so that exception does not apply. That makes us happy, and so we can again take some notes. So first, yes, it is definitive. Can the withholding tax or can the definitive effect of the VHT be removed? That's for A. We could call it for A. And the answer is no. CPER 52 sentence 7 would only be possible, not the other way around, if Mr. Ting were citizen of an EU or EEA state plus lived in the EU. These conditions are not completely fulfilled. That's it. For B, can the amount of the VHT be reduced according to special rules? Is another thing which we could trust. Special rules could be in the national law. So we would have to look again, perhaps in 50A. Let's do it. And you will find something in 50A3 which allows to lower the withholding tax under 50A by deduction of some business expenses if you communicate them in a clearly checkable way to your business partner. But again, here is a big surprise if we take a closer look to these rules, and therefore we just do that. This is now again 50A, not 52. So directly after the passage of the law where the percentage of the withholding tax was named, we get an information that in certain cases the person owing the consideration may deduct such business expenses and income-related expenses from the revenue which are directly economically connected, which limited liability taxpayer has proven to them in a way that the Central Federal Authority for Taxation is able to check them, or in case that they have been paid by the person owing the consideration themselves. Now again, the fatal blow comes. That is only applicable in cases where the limited liability taxpayer is a citizen of a member state of the EU or of another state of the European Economic Area, EEA, and has residence or habitual abode in the territory of one of these states. And that, ladies and gentlemen, naturally and surprisingly is not true in our case. So bad luck. Let's go back to the case. We know there is no reduction possible, at least under national law, because I just tell you now there is no other basis for a reduction which could be claimed under ESDG or KSDG rules. Just take it from me. So 50A3, no reduction possible because Ting is not a citizen of the state of the EU or of the EEA. Then a reduction might be possible under double taxation treaty law, and that is something which we have not yet spoken about and which cannot yet be expected from you. In this case, does not have to do anything with double taxation treaties, but I can tell you that's not possible in all the relevant cases. In all important double taxation treaties, the right to tax supervisory board remuneration is always given to the country of the company and is never restricted by a threshold, an upper limit or so. So, no. Under EU law, that would be the last category of law which could be imagined, and the answer is no basis for additional claims can be seen because, well, naturally, the rule in 50A3 goes back to a demand from European jurisdiction. So it could only be interesting to look for additional potential claims which you could raise under EU law, for example, a non-discrimination rule there or something else like that. But there is none. By the way, for practical things, there might still be something which could be interesting. And which is very often overlooked. There might be a clause in Article 24 or so, one never knows the exact number of the DTT concerning clause forbidding discrimination according to citizenship. Then Mr. Ting could claim equal treatment because he lives in the EU, like 50A3 demands it, plus the only missing criterion for 50A3 is his citizenship, and that under this specific DTT rule may never form a criterion for a more negative treatment. That's disputed, and this is just an additional information. Now, as we have no business expenses given here, there is at least no practical way how we could reach deduction treatment in assessment. Well, definitively taxed, so not included in an assessment in Germany. Yeah. Question 2. If Consul Ting also had a French passport, could he opt for tax assessment in Germany? And now, please, before you criticize me, I have no idea if Chinese citizenship rules allow that you have double citizenship. So French law does it. So I just invented that in this specific case, Mr. Ting is a Chinese national and also holds French citizenship. Please just accept that. It has just been invented. Do as if it were the case. We do not know if that is possible in real life. We just assume it is. And if that is the case, then it's clear, then he is also an EU national. EU jurisdiction clearly says if Germany is obliged under the European Union treaties to give the citizen of another member state certain rights, then this is an obligation for Germany, and then Germany can't say we are obliged to treat every French citizen equal to a German, but we reserve the right to decide who is a French and who is not a French person, because that trick would be too easy. That's not allowed under European Union law. So whoever holds French citizenship, and however long that person holds citizenship of France, when the French say you are French, and as long as they say you are French, then you are French for European Union law. So yes, then the assessment option under 50A3, no, 52, number 5 ESTG would be possible because 52 sentence 7 ESTG is fulfilled then. Also, the option to reduce the tax base for the withholding tax by withholding tax this way, by business expenses would be eligible, so you could elect it. C50A3 ESTG. Good. So very convenient in this case, as under the present conditions, an option would not be possible. We don't have to bother about the amount of taxes which would have to be paid. If question 2 were to be interpreted by us in a way that we also had to calculate the final German tax, then we would have to keep one thing in mind. You apply to a limited taxpayer the regular tax tariff, but you remove the basic allowance from it, so the zero bracket. And that removal can be done in a very simple way. You just add the zero bracket back to the income. So I believe at the moment the basic allowance is approximately 9,400 and let me guess 8 or so, don't know it by heart. So if we had to look up Mr. Consulting's German income tax in case of an assessment, we would have to look into the tax tariff not for 100,000, but we would have to calculate the result for 100,000 plus reversal of basic allowance plus 9,408 or so. So we would have to calculate the tax under the tax tariff, which comes out for a value of 109,400 and, as I say, I just guess it, 8. Yeah? Probably that would be a tax of 33 or 34,000. So that would show us that it makes no sense, is probably not attractive for consulting to opt for an assessment, at least if he only has this income from Germany and no other things which would lower his income. Okay. That was case number 1, and you know, if I pronounce this way, that sounds as if there might come a case number 2, and indeed that could be the case. So let's look and wait. Now here we have another case, indeed as promised, or as I threatened. The foreign citizen Li Zhen is the founder and shareholder of the Li Zhen SE, a company established under European Union law with seat and place of management in Madrid, Spain. The Li Zhens has to receive a license payment of 100,000 euro naturally from a German company. In addition to that, the Licenz SE is the owner of an office building in Munich in Germany, which it does not use for itself, but which it has let to several tenants. For this reason, it gets rent payments of 50,000 euro. And it sold that building on the 31st of December, and the gain from the sale was 200,000 euro. Treatment under the rules of German limited tax liability, and explicitly ordered you should ignore any deviating rules from German double taxation treaties, because that's the thing for us for a later chapter. Does not bother us. So start the solution. First, personal tax liability. The taxpayer here, the person who gets the income, is the license juridical person. So KSTG is applied. No seat, no place of management in the inland. So that is limited tax liability under 2 number 1 KSTG. So personal tax liability has been dealt with, and now let's go to the events. Event number 1 is the license fee. The license payment of 100,000, which has to be expected. What has to be done with that? The first question is it taxable? We have to check paragraph 49, and we have to do this, and so we do it. It's plain and simple. So paragraph 49, income from business, that is what usually applies for a foreign corporation. And there is no permanent establishment, which the Licenz SE has in the inland, but let's look more. F, which, as far as they do not already belong to income under business under letter A, then business income which has been achieved by lease and rent or by selling, alienation of immovable property, of a complex multitude of movable property, or of rights situated in the inland or registered in an inland public register, or what I forgot here to mention in the translation is, or used in an inland permanent establishment. And that applies here. And so we have 42 number 2 letter F applicable here. So 41.9 number 2 letter F applies. License fee received within a business from a right led to a German PE, here the German company. Because here with the German PE is meant that the PE can belong to everybody, to the person who pays for the license. So it is taxable in Germany. Yeah. Now we come to the next step. Yeah. And the next step is step number 2. Is there a withholding tax? And the answer was, do you remember 50A1 number? It was 3, by the way. That applies. Do you want to take a look to make it sure? We should, perhaps. And as far as I remember, it was 15% of the amount payable. So that would be 15,000 euro. And that was, I believe, 58.2 sentence 1 ESDG. We should check that. So indeed, here is our translation of 50A1 ESDG. That was again the withholding taxes. So we remembered that right. Withholding taxes exist for number one, income paid for performances in the field of art, sports, artistry, entertainment, or similar performances. Income paid for the using the rights or exploiting the inland performances defined in them. And number three, that was what we remembered, in case of income which consists of considerations or payments for the transfer of the use of rights or the right to use rights, especially for copyrights and patent rights, for experience in business, technical, scientific, and similar fields, for knowledge and skills, as for example, plans, samples, and procedures, and in case of income which results from giving someone the opportunity to conclude a contract with a professional sportsman or sportsperson, for a limited period of time. Okay, that's not just our case, but license fees is definitively covered by number three. And so that was indeed correct, that reference. Now let's check if it really was 15%. Therefore, we have to look to 58.2. And indeed, 15%. Only in cases of number 4, that was supervisory board fees, 30%. Yeah. We could already try to find out if perhaps we have an option to reduce the withholding tax, or to know first if it is in principle definitive. And for this, simply look back. 52, we had this here. Is it definitive? Yes. Withholding taxes due paid because of 50A ESDG are in principle definitive, as far as none of the exceptions apply. And here we have below under number 5, for income in the sense of 50A, paragraph 1, numbers 1, 2, and 4, an assessment can be applied for, but not for number 3. So for license fees, the German national law does not allow any option for an assessment. So we can already take a note of these insights in our tax case solution. So withholding tax is definitive according to, and that was a mistake, ladies and gentlemen. It was not 52 sentence 1 ESDG. No. Why? Why could it not be that? Very brutal and simple. We have a KSTG case. And the income tax, which is declared as definitive in ESTG 52, is not paid by an SE. An SE pays corporation tax, and you find the corresponding rule in 32 KSTG. So it should be worth the moment to look there. Okay, here we have it now again, but now in the version of 32 KSTG. The corporation tax for income which is subject to withholding tax is regarded as definitively and correctly paid if the income in question is excluded from a tax exemption of an inland corporation, not our case, or if the recipient of the income is a limited liability taxpayer and the income has not been received within a business in the inland. That's our case. 32.1, number 2. Now the exceptions where an assessment can be demanded. That begins with relevance for our case in number 2. Corporation tax is not regarded as definitively paid, so needs to be subjected to an assessment. Number 2, for income which is subjected to withholding tax under 50A1, number 1, 2, or 4 ESDG, if the recipient of the payment applies for an assessment to corporation tax. Note, please take into consideration that number 3 is explicitly not mentioned. And there is also a surprise in paragraph 4, because here we get again a restrictive EU clause. Paragraph 2, number 2, that was the right to apply for assessment for several withholding tax cases, but not for our case, only applies for limited tax liable corporations, associations, and masses of property, as meant in paragraph 2, number 1 KSDG, which are established under the law of an EU state or the law of a state of the European Economic Area, and which are companies in the sense of Article 54, Treaty on the Functioning of the European Union, or Article 34 of the European Economic Area Agreement. So both cases, which means which are covered, which have the right to freedom of establishment, and whose seat and place of management is within the territory of one of these states. And that, that could be the case here, because the LIABILITY SE is established in Paris, has seat and place of management in Paris. But now, unfortunately, German law does not grant any right to an assessment for revenues which are covered by 50A1 number 3, so not for license fee. So it's definitive under 32.1 number 2 KSDG. The definitive effect of the withholding tax can not be removed by application under section 32.2 number 2 KSDG, because there is no right for such an application in case of license payments, surprisingly. So treatment in an assessment not included, because definitively dealt with by the withholding tax. Next event, rent income from Munich. Here again, first question, taxable, and the answer was yes. Again, this is 41.9. Number 2, income from business, and the letter is F again. Income of a business from lease and rent of immovable property in the inland. Yeah, so the tax base is a profit, and taxable is an amount of 50,000, by the way, plus gain from the sale, because it is now business property what we have here. So plus 200,000, so we have 250,000. Withholding tax for that, and the answer is no, it is income from business and income from lease and rent payments. For both, no withholding tax in paragraph 50A ESTG. So no reason why that should be treated there correspondingly. So 3 to 4 don't happen here. Treatment in an assessment. Well, part of the world of the taxable inland income of the SE. Tax base complete here, as it is the only event, 250,000 euro. If we had some other sources of income which also go into assessment, for example, might be negative, they might lower the total of the income, but here is only one. Well, tax rate 23.1 KSTG. You will learn that in the business taxation lecture. 15%, that is just by coincidence the same rate as the withholding tax has, but this is a coincidence, so never mix these two things up. And if I am allowed to take a look to a calculator, 15%, because it's late now, I don't want to make a mistake. 37,500 euro is the tax which is due. End of the case. And ladies and gentlemen, I don't know how you feel. I feel at the moment rather a bit exhausted. So I should think we should think about something like a break.